Okay, so to help you prepare for your upcoming quiz, allow me to discuss with you the multiple choice on inventories. So this is taken from Intermediate Accounting by yours truly, 2022 edition. So we are solving chapter 1, inventories. So we start. Which of the following would be reported as inventory? So 1, land acquired for resale by a real estate firm. So as far as the real estate firm, that is good held for resale. So that is inventory. Agricultural produce held by a farm. So that is also inventory. Partially computed goods held by a manufacturing company. So this is work in process, which is part of the company's inventory. Machinery acquired by a manufacturing company for use in the production process. That machinery, although used in production process, is classified as property, plant, and equipment and not inventory. Therefore, it's letter B, 1, 2, and 3. Goods on consignment should be included in the inventory of the owner, of course, the one who economically controls the goods, and therefore that is the consignor. Which of the following shall be included in the cost of inventory? Selling costs. Selling costs are period costs. They are recorded as selling expense. So, no. Freight charges on goods acquired, FOB. Destination. So if that is FOB destination, then it is the responsibility of the seller to pay for the freight cost. Therefore, this is not for our account. Abnormal amounts of wasted materials, labor, or other production process. Because this is abnormal amount, then this is taken to profit or loss, not an inventoriable cost. So letter D is storage costs that are necessary. Please take note that there is qualification here. So under IAS 2, storage costs are not part of inventory unless they are necessary to a further production process. And therefore, this is included now because that is necessary to a further production process. So there is typographical error there. So it's letter D. Inventories encompass 1, merchandise purchased by a retailer and held for resale. So that's included. Land and other property held for resale by a real estate developer. That is inventory. Finished goods produced. That is inventory. Again, abnormal amounts of wasted materials, labor, and other production costs. Not included because, again, this is treated as period cost. So this is taken to profit or loss as expense. Therefore, it's 1, 2, and 3. Under the shipping terms, the buyer pays for the freight, which legally must be borne by the seller. Therefore, it must be the seller who is responsible for the freight. So that means that is FOB destination, but under the arrangement, when the goods are received, only then that the shipping company will collect the freight. Therefore, that is freight collect upon receiving the goods at its destination. Therefore, it's FOB destination, freight collect. When using the periodic inventory method, which of the following generally would not be separately accounted for? It would not be separately accounted for, so there is no account title of its own for the computation of cost of goods sold. So trade discounts applicable to purchases during the period, and trade discounts are not recorded. They are immediately netted against the recorded purchases. So they are not even reflected in the invoice price, or the invoice price is net already of the trade discounts. Therefore, easily that is the answer. So cash discounts taken are recorded by the entity. Purchase returns, they are recorded. Cost of transportation in recorded. So how should the following costs affect a retailer's inventory? Freight in, Freight in is part of inventoriable cost, so that's increase. Whereas interest on inventory loan, so interest on inventory loan is considered as finance cost unless interest is incurred on an inventory that qualifies as a qualifying asset. So, kailan yun? That is when the inventory takes substantial period of time before it gets ready for sale. So let us say we are constructing a ship and it takes several months or even years to fully complete the ship, barko. And we borrowed funds to finance the construction of the ship. Then in that case, the item is a qualifying asset, provided that that ship qualifies as an inventory. Therefore, ordinarily, it's not. Therefore, it's letter A, increase for freight in and no effect for interest on inventory loan. 8, which of the following statements are true regarding perpetual inventory method? Purchases are recorded as debits to inventory account. That's correct. So that is perpetual. Your entry there is to debit inventory and credit accounts payable. The entry to record the sale includes a debit to cost of goods sold and a credit to inventory. So at the time of sale, there are two entries, one to record sale and another is to record cost of goods sold because selling involves an outflow of goods. 3, after a physical inventory count, inventory is credited for any missing inventory. Yes, so physical count here may be necessary, not for setting up the ending inventory, but to determine whether the actual inventory on hand would tally with the inventory per record. And if there is any missing inventory, we need to adjust the inventory per record to be consistent with the actual inventory. Therefore, we are to debit a loss account or cost of goods sold, whatever is the account used by the entity, but you are crediting inventory and you are crediting inventory. So that's true. 4, purchase returns are recorded by debiting accounts payable and crediting purchase returns and allowances. So the account title purchase returns and allowances applies only when using the periodic inventory system. Therefore, that one is false. Therefore, it's 1, 2, and 3. Which costing method is appropriate for inventories that are segregated for a specific project and inventories that are not ordinarily interchangeable? So the goods are specifically identifiable and there is only one method, that is specific identification. Which of the following inventory costing method reports most closely the current cost of inventory on the statement of financial position? Also, if we say current cost, that means that the inventory is valued using the most recent purchase price, and that uses the first in, first out method, because under the first in, first out method, first items purchased would be the first items to be sold or to be issued, such that the inventory is valued using the most recent purchase price. During periods of rising prices, when the FIFO inventory cost flow method is used, a perpetual inventory system would not be permitted. It's permitted regardless of the trend in the prices. Letter B, result in a higher ending inventory than a periodic inventory system. No, they result in the same. So this is the only costing procedure that would give you the same cost of inventory whether we use the periodic or the perpetual, and regardless as to whether there is rising prices, there are rising prices, decreasing prices, or just steady price. Therefore, it's letter C. In a period of rising prices, the inventory cost formula that tends to result in the highest reported reported profit. So what's the principle? The higher is the ending inventory, the higher is the profit, because as we have taken up, ending inventory is directly related to profit, and inventory cost, ending inventory cost is higher in period of rising prices under the first in, first out method, because the inventories are stated at the most recent purchase price, and the most recent is the increased price. When using the moving average method of inventory valuation, a new average unit cost. So when preparing a stock card, a new average unit cost must be computed after each receipt. So that is after each purchase. In periodic inventory system that uses the weighted average cost flow method, the beginning inventory is net purchases minus the ending inventory, no? So your usual formula, even with the use of the periodic or the perpetual, is that beginning inventory add purchases. That gives you goods available for sale. Deduct ending inventory. That gives you cost of goods sold. Okay, so this one. Okay, so net purchases minus the ending inventory, no. Net purchases minus the cost of goods sold, no. Total goods available for sale, this one, minus the net purchases. So we are working back. Yes, therefore it's letter C. Actually, total goods available for sale minus the cost of goods sold is the ending inventory. Under the net method of recording purchases, net method. So actually, that was discussed in the previous chapter. The purchase discounts not taken. So purchase discounts not taken. Therefore, what's your entry? Your entry is to debit accounts payable at gross. No, at net. Credit cash at gross. And debit discounts lost for the difference. Therefore, under the net method of recording purchases, the purchase discounts not taken is reported, this one is reported as finance costs. The retail inventory method would include which of the following in the calculation of the goods available for sale at both cost and retail. Okay, so which one will be included? So purchase returns, yes. So for purchase returns that involve physical flow of goods, both your goods available for sale at cost and goods available for sale at retail must be reduced accordingly. Therefore, it's letter A. Sales returns would affect only the retail. Markdowns and markups also affect only the retail. Which of the following relating to inventory shall be disclosed in the entity's financial statements? Cost formula, yes, because that is part of the company's accounting policy. Volume of inventories purchased during the period. Volume means the units purchased. So is it necessary to disclose? Not necessary. Amount of inventories recognized as expense during the period. Yes. So that is cost of goods sold under the function of expense method, under the nature of expense method, that is purchases adjusted for the change in inventory. Amount of reversal of write-down of inventories, yes. Amount of inventories pledged as loan security. Any asset that is pledged as loan security always requires disclosure. So therefore, it's 1, 3, 4, and 5. So it's 1, 3, 4, and 5. So it's letter D. The average retail method is based on the assumption that the ratio of gross margin to sales is approximately the same each period. It's not necessary. You are computing actually the cost ratio based on goods available for sale and goods at cost and goods available for sale at retail. Ratio of cost to retail changes at a constant rate. It's not necessary. Letter C, beginning inventory and the cost of goods sold contain the same proportion of high cost and low cost ratio goods. Actually, it's not the beginning inventory, but the ending inventory. Therefore, the answer is gross margin percentage applicable to ending inventory and to the cost of goods sold during the period is the same. So that's the answer. Therefore, so both the cost of goods sold and the ending inventory is based on the same cost ratio. So it's letter D. Which statement is accurate about calculating the cost ratio to be used under the average retail method? So under the average retail method, you are to add net markups. And you are to deduct net markdowns at retail price. But you are to include beginning inventory. So again, include because this is average beginning inventory. So beginning inventory must be included. Your choice will be between C and D only. No, between B and C only. So letter B, beginning inventory is included and markups are not, and markdowns are not deducted. They are deducted. The beginning inventory is included and markdowns are deducted. Markdowns are deducted. The net markdown. Therefore, it's letter C. A company using a periodic inventory system neglected to record the purchase of merchandise on account at year end. So purchases understated. So what happens to profit? Because purchases is an expense, that means profit is understated. The amount of this merchandise was omitted from the year-end. No, here, purchases were understated, profit is overstated because purchases as an account title is an expense. So if expense is understated, profit will be overstated. But the same goods were omitted from the year-end physical count. Therefore, your ending inventory is understated and ending inventory is directly related to profit. Therefore, profit is understated. Therefore, the net effect, there is no effect. So how will these errors affect inventory at year-end and cost of goods sold for the year? Therefore, for the ending inventory, it's understated. For the profit, it's no effect. Therefore, it's letter D. During 2022, the meat company signed a non-cancelable contract to purchase 2,000 units of raw material, so it's non-cancelable, at 32 per pound. On December 31, 2022, the market price of the raw material is 26. So 32 minus 26, that's a decline of 6. And the selling price of the finished product is expected to decline accordingly. The financial statements prepared for 2022. So this is non-cancelable purchase commitment, and there is a loss because of the decrease in the market price of the committed goods. Therefore, your entry is to debit loss on purchase commitment, credit estimated liability on purchase commitment as discussed in the video lecture. So that is for 2,000 at 6. So that is 12,000. So the financial statements prepared for 2022 should present a loss in the statement of comprehensive income amounting to 12,000 and should report a liability in the statement of financial position amounting to 12,000. Therefore, it's letter D. '22. Galleria Sportswear Incorporated regularly buys sweaters from Bond Company and is allowed a trade discount of 20% and 10% from the list price. Galleria made a purchase on March 20, 2022 and received an invoice with the list price of 90,000, a freight charge of 5,000, and payment terms of net 30 days. What is the total cost of the inventory purchase? And therefore, net of trade discount, that will be 90,000 list price times 80%, deducting the first 20%, times 90%, deducting the second trade discount rate. So that is 90,000 times 0.8 times 0.9. So that's 64,800. Add freight amounting to 5,000. Okay, therefore, there is no cash discount. So it's 69,800. Celine Company purchased an item of merchandise quoted and listed at 150 under the following terms. Trade discounts of 15, 10 and 5 to 10 and 30. So what was the invoice price? Invoice price lang po ang tinatanong. So that is net of the trade discount. So that is 150,000 times 85% times 90% times 95%, deducting the discount rate of 15%, 10%, and 5% from 100%. Therefore, that's 150,000 times 0.85 times 0.9 times 0.95. So that is 109, 012, and 50. Use the same information given in MC23. How much was the cash payment if settlement was made within the discount period? So you have 2% discount there. So it's 109, 012, 50 times 98%. Therefore, the cash payment is 106, 832, 25. In MC25, Rock Distributors, a computer store in Vera Mall, specializes in the sale of IBM compatibles and software packages and had the following transactions with one of its suppliers. The question is, how much were the discounts lost? So you are given purchases of IBM compatibles 3,280, purchases of commercial software package 900, returns and allowances 80,000, purchase discounts already taken 27,000. Purchases were made throughout the year on terms 3, 11, and 30. All returns and allowances took place within 5 days of purchase and prior to any payment of account. Therefore, how much were the discounts lost, assuming that the discount period already lapsed. So that is 3,280 plus 900 minus 80. So the amount subject to discount is 4,100,000 times 3%. Therefore, the discount that is available is 123,000, but the discount only taken is 27. Therefore, discount lost is 96. So it's letter B. Okay, so I will stop sharing and will continue with another video.